Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Jim Royal, who'll be talking about his book, The Zen of Thrift Conversions, How to Turn Hidden Bank Stocks into Big Gains. It's an absolutely fascinating discussion about how you find these things, how you analyze the opportunity, who you should follow, and how to take advantage of what they do through the whole life cycle of from the demutualization or the conversion to a public company through the IPO to the sale. We'll be talking to Jim right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hey, tell me about Jeopardy.
Yeah, so I had really been trying to get on there for years and years and years. In fact, in 2007, I qualified for their audition, and they finally started doing them around 2005. They started doing them online, right? And I was like, this is perfect, right? Because normally you had to, like, if you were in LA, it was great because you could just kind of go to their open auditions and things like that and take the test and whatnot. And finally, they started doing them online. And so it was like great for somebody like me who lived in Florida. I could just, and they did them once a year. I qualified like early on 2007, couldn't go because I was actually on my honeymoon. And I had to like skip the audition. And then I got back another call back in 2011, got another call back in 2014 or 2015, then got a call back in 2018, and that finally led to getting on the show. But really, it was like something I wanted to do since like the 80s. So
How was the experience?
Yeah, it was absolutely a blast. Meeting Trebek was, of course, the highlight. But so I was the last, so they do 5 tapings a day. And so I got to see all the shows that would air that week. And then I was the Friday show. And it was a blast. But you get up there and 20 minutes later, it's done, right? And it goes by so quick that you don't even realize, we're already halfway through and they're taking the commercial break. And, it was so much fun though. And I was glad that I got to stay the whole day and see everything, just sort of absorb it all. And it's unfortunate, I would say, how it worked out for me. What
question sunk you?
Oh, it was really like one of my worst categories. It was female singers mononymous. So like one named female singers. And so like, that's how like on my Twitter handle, right? I've got that pinned at the top, right? And, and basically at that point, I had about 45% or so, closing in on 50% of the money of the leader. I'm like, I know there's one more double Jeopardy out there. I've got to try to get it, right? And so I'm sort of hunting around to try to get it. I do get it. And I'm like, all right, this is the time. I got to bet it all now to have any shot of winning. And so I do, right? And so like, to me, that's the way you play the game, right? You use those other non-trivia elements to try to compensate or try to accelerate the performance. And it just didn't work out. And, there was another question about steel, right? So if it had been about a steel company, I would have nailed it. But no, it had to be about like really my worst category. So that's what it was, but an absolute blast and super fun. And just really glad I finally got the opportunity to do it. And
the answer was Adele, right? What was the question?
Exactly. It was basically something like this singer said, I don't want to look like I'm happy with how I look. I don't want to look like, because I represent everyday women. Yeah. That's one of the strange things though I'll mention is that watching it, 3 months later when it actually aired, I was like, I don't know the answer to that question. And there I am on screen answering the question right. And so I'm forgetting you're just so zoned in, right? You're just like super focused. And so it was like stuff stuff sometimes come to you that you don't even remember, that you even know, right?
So you've written a book, this is why we're chatting, also because we've known each other for a little while via
Right.
Twitter, and I've always been a big fan of your special situations approach. But your book is, I'm just holding up to the camera now. It's The Zen of Thrift Conversions. I've been searching for the Zen and the art of thrift conversions over and over again, but I found it. It's the Zen of Thrift Conversions. What prompted you to write an entire book about thrift conversions?
Yeah, so it's the thing is ultimately, I mean, it's sort of multiple impulses here. Basically, one is there's no book out there about it, right? And so
I'm shocked.
Yeah, right. It's been a sort of special situation for 30 years, and there's nothing really out there sort of comprehensively discussing it. So it was, I think, an opportunity to sort of collect all the knowledge about how to do it in one place. And really the book is so much a practical guide about how to do it, right? Like, here's what it is, here's the structure, here's why it creates value, here's why you have an opportunity. And also let's hear from what the investing greats have said about it, Klarman and Peter Lynch previously in some of their writings. And then let's look at the guys who dominate, the activist investors who dominate the space, right? So you sort of get this comprehensive picture about thrift conversions, how to do them, how to make money, what to watch out for, et cetera, right? And so for me, like, it took me probably 10 years before I stumbled onto thrift conversions, right? It's just really kind of backwater of the market. And so, like, I finally got there. I'm like, hey, these are really interesting, right? These are really low risk plays with some, medium upside here, and sometimes high, depending on pricing. And I thought, hey, this is a great opportunity. Why did it take me 10 years to catch on to this? And so it's really written for somebody who's not familiar with these, to try to get them up to speed. It's really a crash course on how they work.
Well, why don't we start at the start? What is a thrift conversion?
Yeah, so a thrift conversion, basically you have this whole class of banks that are mutually owned. They're owned by their depositors, right? And they're really kind of private banks that there's about a little more than 450 of them left in the US today. Previously, there were more than 1,000. And it's owned mutually by the depositors. And at least in theory, legally, they sort of own the capital in that business. But that really doesn't mean very much. They don't get to access it. They really don't have a lot of say in how it's used or anything, right? So they don't, for all intents and purposes, really kind of nobody owns the bank. And so what happens is basically these banks then go public, right? So it's a kind of recapitalization transaction. And the depositor owners get to subscribe in the IPO offering. And usually it's mostly restricted to the depositors who can participate in the IPO. And actually, it's a really great setup, as you can imagine. The depositors are really kind of selling it back to themselves, and management is on board. And so that the economics are tremendously favorable here, right? Because in many cases, you've got an already profitable bank. Usually it's got plenty of capital already, and then they add more capital into it. So basically, shareholders who participate in these get a bunch of capital in their bank for free, which is to say they get to buy an overcapitalized bank, usually at a below tangible book price. And it's hard to go wrong ultimately.
So is it a matter of they've sort of they're using it as customers of the bank. They need some sort of, they're using it because they want to take advantage of the services, and then they get given the shares, and they're not necessarily, they just view that as sort of found value, and they tend to just sell them and grab it at the time. It's a little bit like a spin-off where folks aren't necessarily interested in holding it. Is that what creates the opportunity?
I think there's definitely some of that, because a lot of the depositors in these banks really don't know a lot about this, and plenty do. So I don't want to sort of paint too broad a brush here, but because there's a lot of investors who do participate in, deposit their money in the mutual, and then try to participate in the IPO. But there's plenty who don't. Plenty are just in there for the first day pop, if you get them 15 to 20% upside, and then they're just kind of gone, right? And they're not interested. But I think that there's really two aspects to this. The first is there's an alignment between insiders and outsiders here, right? So on the one hand, basically you're buying on the same terms as the insiders, because in a traditional IPO, what you've got is a bunch of insiders selling to outsiders, or either their own shares, or raising new capital, and that's not the situation in a thrift IPO, right? Because in some sense, effectively nobody kind of owns it. You've got different motivations, and so the insiders, so the bank insiders who are participating on the same terms as the outside shareholders, right? So you don't have that same sort of inside outside dynamic that you have in a traditional IPO. And so they're also interested, as you might imagine, if they're, as we see in other, spin-off realms, where they're interested in giving themselves cheaper options and things like that. What you've got here, they've got their thumb on the scale a little bit in terms of valuation, right? So there's a nice setup there where they can keep the valuation a little bit lower. But that's the first part. The second part here, though, is really, it's because a lot of the value comes from, you've got this inaccessible capital, right? So that when I put up new capital, I then suddenly get access to this previously untouchable capital, right? So I'm just really kind of being given free money as the bank. I mean, Peter Lynch calls this the hidden cash in the drawer trick. Basically, you buy a house and then you go in and you've got your purchase price back in cash in a drawer, in a kitchen drawer in the house, right? And so that's the sort of sense in which there's kind of free money here. To sort of conceptualize it a little bit differently, the bank basically promises to give you that access to that capital if you put up a little bit more. So you're always getting something in excess of what you put in.
So to summarize, the insiders, unlike a normal IPO where the insiders are trying to get the highest price they possibly can, these insiders, because they want to participate, because they're basically employees becoming owners, they want to participate. So they're also interested in keeping the price low. So they're sandbagging a little bit. Do you wind up who ends up controlling? Does there ever end up being a big concentrated controlling shareholder, or is it a very dispersed shareholder base?
Yeah, I mean, it tends to be fairly dispersed. There are certain rules on how much management can own. I think it's around 25%. That usually doesn't come into play a lot. I mean, one of the things you can see certainly in the prospectus for the offering, you can see how much management is taken down in the offering. And you'd love to see, of course, them hitting their maximum. There's certain maximum thresholds that any shareholder can buy in the offering, and you'd love to see that those eight or 10 named executive officers just taken down to full allotment.
Right.
But yeah, it tends to be pretty dispersed. You'll get some activists come in, Joe Stilwell, Larry Simon, Rich Lashley, who or others potentially, but those are really the three biggest names, I would say. And sometimes those guys will buy an 8 or 9 or 9.9% position if they really want to affect change. But they tend to be pretty large shareholders. And then another large shareholder although it's a little bit of a different beast, is a pension plan or something like that, or an options plan for employees that might take down 6 or 8% of the stock right out of the offering. But that tends to be, a really kind of passive shareholder.
So how do you go about hunting for these things? Where do you how do you search for them?
Yeah, so like multiple ways, I would say, right? I think a lot of times people focus on the specific conversion aspect, but a real part of the value here is later on too, right? So like is the years one through 5 typically when most of these things eventually got bought out. So there's really two key distinct life cycles here, and really you can search for these if you're doing looking for S1s or things like that off the Edgar database. If you're looking for the IPOs to keep those on your radar, and it's got pricing in there and everything, so you can figure out a range of where it's going to be priced. And often these IPOs come off between 60 and 80% of tangible book value. So you look for the IPO prospectus, or then you look in the secondary market. I follow all of the recent ones, whether it's IPO or upcoming IPO or stuff that trades in the public markets on the Zen of thriftconversions.com. So that's like a super easy place to go and just see what's going on. Normally you have 4, 5, 6, maybe up to 10 IPOs a year. So it's not a particularly hectic schedule.
When you say, so they're listing these things at 60 to 80% of tangible book value, I know you've got a reference on the site to finding these things that are worth more dead than alive. Is that what you're referring to? And why are they doing that at a discount to tangible book? Surely you just get it away at book. Yeah,
so it's really the nature of it's really like the nature of something being given away for free. So how can I charge a tangible book price when I'm giving you something for free on top of it, right? So that's it's just a sort of basic, and the thing is, regulators have struggled with this for years, right? Because they don't want these windfall profits, right? But there's almost no way to get around it. So I actually kind of go through a little bit of the mathematics very briefly in the book and showing how regulators have struggled with this previously. Like, again, if I give you something for free and you pay what looks like a fair price for it, you still got something for free on top of that, right? You still got that the bank's capital on top of whatever you paid. So how the mathematics. And in fact, the mathematics of the valuation just don't make any sense, right? To really kind of balance the equation, you have to assume the bank destroys capital. And that really just doesn't happen. It's just the nature of that transaction where you get something as a bonus for what you put out.
So when let's say you find one of these opportunities, how do you then size it up? How do you determine whether it's an interesting opportunity for you? What are you looking for?
Yeah, so I think in the book, one of the things I go through is a sort of 9-step checklist to really give you good first rough cut on whether the thrift looks interesting, right? But if I really kind of had to boil that down to 3 qualities, I'd look at price to tangible book value, return on equity, and equity to assets, right? Price to tangible book will give you some sense of what upside you might have. And, one of the great things about investing in thrifts is, this is not an open-ended growth opportunity. If you sell today, it's not probably likely to double, right? But you have some range in which your value is, right? And so based on whatever your buy price is, if you can buy it 70% of tangible book, you probably have good upside at least until 100% of tangible book. And then a lot of these, over time, the average multiple is around 140% of tangible book that these get bought out at. So it can be relatively easy to calculate your potential returns and potential IRRs here. So price to tangible book is a great one great quality to look for. Return on equity, you want to see consistent record of profitability here, so that they aren't burning your margin of safety with by taking down book value.
What sort of returns on equity do they tend to have? Because they're sort of that. I imagine if they're a mutual or they're not necessarily run for profitability. So how do you kind of make that translation from mutual to now for profit?
Right. I think for some it's difficult. And of course, having in many cases, these banks are raising 150% more capital than they already have, right? And so they're suddenly like, we've got all this money, returns on equity plummet. But in any case, they're small, they're subscale. They've got they've got to stretch fixed costs against basically a small revenue base, small customer base. And so the returns on equity, like a good one might be 5 or 6%, right? In general, right? Because you're dealing with banks that have 250 million in assets, 500 million in assets, right? Maybe sometimes $1 billion in assets, right? So they're just not really of scale. And then I'll point out the final one, the equity to assets, is a great metric to look at here, because that gives you some idea of how much buybacks they can do, how much excess capital they have in the business. The equity to assets also gives an activist who comes in some room to work with in terms of pushing stock repurchases, which is a really a big tool in the activist playbook, pushing more of that money, either buying back the tangible book, buying back to up to tangible book value, and just getting that money back to shareholders. And of course, then it provides safety, gives you some margin of safety if they write some bad loans or things like that. So, the equity assets is a great one to look at.
What do you look for there? Like, what's the sort of outer limit of where you feel it's safe?
So the strange thing is these banks have a serious problem when they go public. They have ridiculous amounts of cash, right? So it's really not at all unusual. I've got my spreadsheet of thrifts, and you've got these new thrifts with easily 15 to 16% equity to assets. It's not unusual to see them with 20% equity to assets. One that completed its second step conversion, I think it was last year. Last year has over 30% equity to assets, right? It's when you start getting down to 10 or below, the activist doesn't have a lot of room to work there, can't force a big buyback. And even if the company was, or management was predisposed to do a buyback, they just don't have a lot of room to work, a lot of room to maneuver.
Do you spend any time examining the nature of the assets that they have, or do they tend to be sort of, is it checking accounts and things like that, or do you look at the loans that they've made against, commercial real estate somewhere a bit racy like Las Vegas or somewhere like that?
Yeah, the thing is, so so if you're looking at deposits on the liabilities side, one of the big things is how valuable is that franchise, right? And so definitely looking for, this is one of my 9 metrics. You want to see how much is time deposits versus non-time deposits. If you've got a lot of stuff in, checking, savings, money markets, that's more valuable for an acquirer than your CDs and things like that. So that definitely gives you an idea of how valuable, or whether it would be more valuable to an acquirer. And since that's largely the end game here, that's something you want to be aware of. And then, if you're looking at assets, so many of these are really focused on residential type of stuff, like really plain vanilla kinds of stuff. And I admit that's a pretty broad brush, but a lot of these thrifts are located in they've got 1 or 2 or 3 or 4 branches and they're small rural areas in some cases, not all, but so they don't usually have particularly especially risky lending generally.
So the activists in this space, they're looking for a big discount to tangible book, and then they want a very conservative equity assets, and then their playbook is to basically go in and say, buy back stock until we hit tangible book or we get to that sort of limit of equity to assets. So the three big players, I recognize Joseph Stilwell because he's active outside of that. Do you just want to give us a little thumbnail sketch of who they are and how they tend to operate?
Yeah, sure. So I just give a couple broad things, and you know a lot of what it's a lot of the activists really go into stocks that are fundamentally mismanaged, and not even necessarily the cheapest things, right? But the stuff where they can actually have an effect for some good governance. I mean, one of the key problems here for activists is you've got insiders who haven't run a public company, right? They've got no experience. The governance is really not very good, right? You look at the board of directors and it's the CEO's friends from around town. And so there's like significant governance issues that need to be addressed. And just generally, for many of these guys, the bank, it's their bank, and they've been at the bank for 20 or 25 or 30 years, and they see it as theirs. And so when it's actually owned by shareholders. And so a lot of what the activists go in and do is really have to shake up that mentality, right? So Seidman basically is the guy who invented activist investing and thrifts, right, back in the 80s, and kind of completely inadvertently, like he just kind of got into the activism inadvertently, which he goes into the story and the backstory in the book, and that's a great read in terms of how he gets into it. But I mean, whether it's Lashley or Stilwell or Seidman, they're really highly focused on the governance aspects of the bank, and so much of their playbook, and it's not exclusively, but so much is about getting these banks sold because they're just really never going to be of scale, make a suitable return on equity and things like that. Now you might think, hey, why is this an attractive place to invest? It's largely because an acquirer can come in and cut a lot of costs and things like that. And so, the value to an acquirer is much more than being reflected in the public markets.
So you've been a long-term special situation investor, and anybody who's read Greenblatt's book has probably started out doing some of those strategies have sort of gone out of favor a little bit, possibly because they've become so popular. And it used to be, when there was a spin-off, you bought the spin because that was the orphaned. But I think that management teams got smart to that, and so they really started loading all of the junk into the spin, and so that sort of has been, or investors sort of became aware of the opportunity and sort of aggressively bought the spin. What are you? What's your sort of palette of what are your special situations? What are you interested in these days besides the thrift conversions?
Yeah, so I definitely historically was more interested in spinoffs, or that's sort of where I initially approached this from. And I think to your point, I think one way actually maybe nowadays is you buy pre-spin, right? And if you get and that gives you some optionality on the pricing, right? So that if you've got if you've got a spinoff that comes out overpriced, then sort of basically by nature, you've got a parent company, if you find it attractive, that's underpriced, right? So I think there's some ways to sort of compensate for that dynamic, although maybe not as attractive as it was, like you say. As far as things right now that are interesting, I don't know. I mean, I'm a little bit. I feel like a few years ago we were getting some really interesting spins. I think of 2015 with the PayPal spinoff, and that's one actually where we played. We bought early, and then PayPal came off. Perhaps that everybody sort of knew that was the attractive part, and eBay, I think, came off initially a little underpriced, and so you could play that optionality via eBay. We had Cable One a few years ago, which was tremendously attractive. Both PayPal, Cable One are up 5 times since then. I don't know. In the recent years, I haven't found a whole lot that I found interesting.
Fiat Chrysler, does that factor into you? Is it too old? Or that Fiat Chrysler was like a piñata for a while. There was some good stuff coming out.
Right. That's not one I'm super familiar with. But
what about anything else besides spins? So spins and thrift conversions.
Those tend to be the biggest, and I like those. I like both of those because they keep happening, right? We've got a cycle of spinoffs, we've got a cycle of thrifts, and you've got those patterns there that you can keep watching for. I do look for others, but a lot of them tend to be a little more idiosyncratic, right? There's a specific structural factor that is not as thematic as a spinoff, or not as thematic as a thrift conversion, and those tend to be I like the structural element, and I try to get that advantage, that edge when I can. But those, I think, are a little bit more difficult to find.
Is it concerning at all that there were 1,000 thrifts? I didn't quite catch the time period, but there were 1,000 thrifts a few years ago. Now there's 350, or is this a cyclical thing where they tend to, for whatever reason, they expand and contract over time?
No, so the 1,000 is really, quite a few years ago. These have kind of sort of slowly been trickling out at 2 or 3% of the market every year. There really aren't mutuals being created exactly. One of the things you've got with credit unions can convert to mutuals and then ultimately go public that way. So that's one, in fact, a quite interesting a recent thrift conversion. Harbor One took that approach. In 2015, 2016 or so, it converted from the credit union to a mutual, and then went public in 2 steps over a period of 3 years. And that's a quite interesting one. And so that's another, there are literally thousands of credit unions out there that could ultimately take this path. It's a little bit cumbersome. You've got to get members to vote on it and things like that, and to vote on the conversion. But one of the things that we've seen for a long time is the consolidation in the sector. It just does not make a lot of sense to have a lot of economically, to have all these small little banks hanging around. And so if regulators sort of, tried to push a little bit more, we might see more mutuals and things like that. So maybe, should we be worried? Maybe, but there's still a pretty long runway on thrift conversions as a situation.
What about just banking generally, that low interest rates and like a flat yield curve kind of makes it hard for them to make money? Is that sort of part of what drives these smaller thrifts to convert?
Yeah, I mean, it's the interest rate environment is certainly not helping, and that's part of it. There's sort of multiple aspects here too. Compliance costs, whether that's a cost of being listed on the exchange, the accounting costs. There's tech costs that are involved. And so if you've got 250 million in assets, it's it's not really feasible for you to continue as a separate entity. And one of the things that you've sort of seen a little bit behind the scenes here is these thrifts can merge with each other, right? And so some of what they're doing is consolidating some of the back office operations, and then the depositors, if the bank ultimately does decide to go public, still get a piece of the IPO action there. So yeah, the cost structure is just really prohibitive for small institutions, and the economics of consolidation are really only getting more favorable, and so sort of perversely, poor operators are actually more attractive buyout targets, right? There's this just strange dichotomy, strange irony there in that situation, right? You've got these really ugly kind of banks, and that's what I call them in the book. I just say these ugly banks, but actually can make you pretty attractive returns.
I mean, a bank or a little thrift that's generating 5 or 6% on assets, there's a reasonable argument to be made that should be trading at a reasonable discount to tangible book value. Probably should be 40 or 50% of tangible book value. So the opportunity, I guess, is that you see that they can be run much better than they have been. They can be run for profit. And once the insiders start working in that sense, it becomes a much more attractive opportunity.
Yeah, absolutely. And, like in many cases, the insiders here are owners, right? And they don't like to get this payday as owners. You have to go public. There's really not a good alternative. You can't own stock. It's not a stock corporation. So you've got insiders. The game plan here is well known. If you go public and you're not running things properly, you're going to get a knock on your door from Larry Simon or Rich Lashley or Joe Stillwell or some other guys. All right, you got to clean it up. And the other aspect is as I said, they're owners, and so they do have some upside here.
Where do thrifts come from? Why were they sort of these small things established? Is it that a small community didn't have some sort of banking function, and so they've just got together as a group and created it?
Yeah, I mean, just tremendously. It's a very anachronistic kind of situation, right? I think the first one is back almost 200 years ago. I think in the Massachusetts area, and really you had a bunch of people with capital, right, who could put it up and help people get started. And so some of it was about civic virtue, right? Like we the wealthy have some money, and we can help other people who are willing to buy residence, start a business, and provide them capital for what they're doing. And so there's, I think, just a sort of a sense of helping the community, and you still got that perspective that lasts through today. And a lot of mutuals also come out of the 20s and 30s, and with a lot of the charters there are really to make very conservative loans and help consumers buy houses, right? And it's really about helping the community in a way that may not be always aligned with making money.
They were looking forward 200 years in the future, where in 8 generations, there's going to be a windfall when you finally convert that checking account into shares in this bank. One of the things that you say that you can do in the book is supercharge your returns by getting top professionals to work for you for free. Are you referring to the activists, or who are you talking about there?
Yeah, that's exactly it, right? And so really, I don't think there's a sector in the stock market where activists so dominate as they do in thrifts, right? And these guys, the guys I mentioned, Stillwell, Simon, Lashley, really very closely are really devoted to this market, to small banks, banking generally. And if you watch the activist campaigns that they're running, when they run them, when they take shares in a bank, those are great opportunities. And if you follow those campaigns, one of the things I do in the book, right, is discuss specific activist campaigns that I've invested in, run by these guys. And First Financial Northwest, for example, right, with Joe Stillwell about 10 years or so ago, 9-10 years ago. And you could follow along with the actions that he took. Right, ultimately gets the chairman and CEO ousted from the company, and in many cases, you can see really positive developments in the activist campaign and not have to pay for them. Whether that's buybacks or getting better governance or pushing for a sale, these guys really are the bulldogs that don't let go, and they're just going to hang around until they get a positive resolution. And and they're pushing for really the shareholder-friendly moves, right? And so you can really ride these guys' coattails, and they're going to direct you to attractive stocks.
Yeah, that's two of my favorite things: undervalued stocks with an activist involved. I think that's a really good way to get some pretty reasonably safe, good returns in the market.
Yeah, exactly. And you've got an activist who's getting stock repurchased, and you're buying below tangible book, and on and on and on, right? So there's just multiple ways to win here, I think, and it's. In a lot of ways, I think it's classic value investing. Thrift conversions are classic value investing, but I think perhaps unlike classic value investing, there's a clearer life cycle, right? In terms of, you buy cheap and then you get that sellout, right? So that acquisition by a rival. And so there's a clear end gamer catalyst to that value that's well understood. And yet these things still pop up in the market, right? As I said, I was looking, a couple months ago, I was buying a stock at 70% of tangible book value. That was consistently profitable and had a ton of equity.
Fantastic discussion. Absolutely fascinating. If folks want to follow along with what you're doing or get in contact with you, what's the best way of doing that?
So I would point to two ways, either Twitter. I'm all on Twitter and tweeting out IPOs, thrift IPOs when they happen. But then also at the Zen of thriftconversions.com, I've got spreadsheets that super accessible, so you can follow what's out there. And even if you want to participate by depositing money in a thrift before it goes public, you can access the mutuals and see which ones are in your state and which ones you might be able to participate in.
I'll link all of that up in the show notes so folks can follow along. James Royal, Ph.D., thank you very much.